we've had 4 banks go down. A lot of people are kind of freaking out about the banking system. What is it that you see, and does that bother you at all with the rising interest rates that we're seeing?
It just makes capital more expensive. Less competition in the space is not a good thing for borrowers. Not a good thing for all of us who are trying to kind of maximize yield. Just harder, because less competition means higher spreads, and obviously the indexes have been running most of the year. So I think overall it's not a good thing for deal volumes. I think that's probably, I think unless you have to finance, you're probably not looking to finance. And unless you really see an opportunity to buy something right, we're seeing, most of the capital sitting on the sidelines. So I don't know that it's like a game changer one way or the other, but it's definitely kind of more fuel to the fire already that's, causing all these headaches that everyone's experienced, or most people are experiencing right now as we kind of begin to enter into a new cycle.
Yeah. I know you have your finger on a lot of institutional capital. When I say institutional, I say all the way up the chain. Talking about, private equity, institutional equity, family office, everything from Wall Street, and all the way down to Main Street. So where do you see the money going right now? Like, where's it headed, and where's it running from?
That's actually interesting, because we actually have 2 different demands right now on equity and debt cap. So on the equity capital space, we're still seeing demand for larger deals. So that same trend that we kind of saw in 2021, where everyone wanted to do bigger deals, larger portfolios, that remains, I think, a trend in the equity space. Lots of capital being raised, vulture funds being raised, looking to take down big portfolios of multifamilies, where my world is. So that's really the asset class still favored, and people are anxious to attack it when those opportunities arise. On the debt side, we're seeing a bias actually towards smaller deals. So, most of the, life company business that we do is historically always been like, really, they would do the deal if it was 40 million, but they wanted it to be 60 million, and it'd be better if it was 100 million. And so we're seeing for the first time some of those larger life insurance companies that are, had that bias toward much larger deals kind of retreating and saying, I actually really want to be doing $20 million, $15 and $20 million deals. And we can do them larger, but we're not looking to do them much larger. So I think that's been there's a disconnect there in terms of matching the debt capital with the equity capital.
Just talk to you a little bit about the office market. Most of that money, I think, sits up in the life pensions, some of the, it's not necessarily Main Street money, but it's just managed, through their 401ks and stuff. But what do you see? Is that going to disrupt? Because Elon Musk came out with a pretty bold statement and said that the commercial office debt crisis is going to spill over to the single family crisis. So I just want to get your feeling. Do you feel like that's going to spill over into the whole pool?
That's a great question, and not one that I've thought a lot about. We track office. I'm not in San Francisco anymore. I'm now in Nevada, but San Francisco office market is kind of top of everyone's mind, and they're talking about the stress.
Yeah.
And so we just saw like a real trophy asset, trophy asset, 325 California. It's all public information. That the deal hasn't closed yet, but it last traded at $1,000 a foot, and again, it's not closed yet, but the purchase price that's being whispered is $200 a foot. So that's a $300 million deal that's now a $60 million deal, and that's a lot of money. That's a lot of everyone's taking pain in that. So I think that the office story is going to unravel in a way that that I can't predict. I don't see it, but that's a lot of equity destruction and a lot of capital that a lot of capital that's lost. And you would think that means. I would actually think it would mean the opposite, just thinking in terms of like capital flows into real estate. If it's not going into office, then you would think we would have more in residential. But
moving forward, what are you looking at as far as, multifamily and rates and all those things are concerned?
When basically money went totally free, right? And so we had, at one point we had sub 70 basis point 10-year treasury. The argument then was like, well, there's not really a mathematical argument for why cap rates would expand. I mean, we had introduced this new global risk factor in the form of pandemic, but the money was still free. And like, when you just kind of look at where, how do you make those yields work? It just seemed like cap rates had nothing to do but compress. And that is in fact what happened. What's interesting now is that we're on the other side of that cycle, and treasuries are kind of running and short rates are running. So the risk-free capital rate is, 370 now. So, and we would expect to see, I don't know, can you tell me? I would think you want to see 150 basis points of spread for your cap rate on top of the risk-free rate in order to make that a reason. Deals that are not trading at those levels. They're trading at much tighter cap rates than we would have expected. So that's been a big surprise. I mean, my expectation is that will change, and that we will start to see a more rational kind of market clearing where cap rates widen more substantially than they have thus far. But, I didn't never believe in a 3 cap, but it seems like the 475 cap deals that are happening right now really should be 5 or 5.25.
So let's have Ken break that down in a translation for those that don't understand what.
Well, I think said simply, what's happening is, from the buyer standpoint, my cost of debt is more. So the irony is that these assets are still good assets. I mean, the multifamily business is not in trouble. Yes, rates have come down, but we still have positive rent growth. And yes, expenses are up, but so is income. So the irony is that this asset class is still in great shape. I cannot pay the same because my cash flow is less. So I have to pay less. And so that's actually driving cap rates up. It's, so there's a lag effect. And so that's what Clay was talking about is, as a buyer, we solve to cash flow. We look at return and the return from the property, even if it's the same property. So it might be the same property with the same rents, with the same people in it, with the same expenses. What's very different is the debt. So I'm excited to see you at Limitless. For those of you guys are coming to Limitless, that's www.limitlessexpo.com. Clay, as always, man, I love you. Appreciate everything you do. Appreciate your knowledge on all this stuff. We're all just trying to figure it out. So we'll see you in a couple of weeks, and enjoy your day.
All right, I'll see you. Thanks, guys.
Yeah.